everybody. Wednesday evening, 8 p.m. Eastern means it is time for another edition of. Oh, I didn't get this ready. Let me get this ready. Taxes in Retirement Live. I am Andy Panko, host of the show here and moderator of Taxes in Retirement on Facebook. Thank you all for joining me. Tonight should be. I'm not sure what to expect about tonight. So when I originally set the schedule up, I figured let's take an opportunity to discuss the currently proposed tax changes. Now, when I made this schedule, there wasn't any real legislation put forth or draft legislation put forth yet. The things I had in mind to discuss were just the handful of, it was like a dozen or so kind of key points of tax wishes that Biden had proposed earlier in the year. There's since been some more clarity about which things may actually get traction, which not, as you've seen in the group and probably read, like mid-September, I think it was, there was Responsibly Funding Our Priorities draft legislation put forward that seems to have had decent level of bipartisan support at the time. But such is tax legislation and changes. This stuff always changes. The changes always change. As recently as yesterday, I think it was, there was a new proposal put out in draft legislation form from Senator Wyden, which kind of turns some of the stuff on its head. The problem is there's not enough support across the political parties, which are tightly divided as it is, to really get any traction on these things. So tonight's discussion should be interesting. Let me leave it there for now. I see comments are working. Oh man, Dave Fultz, Cody beat you to it. What happened? You okay? Everything all right? Dave Fultz, 2 minutes later, 1 minute later. And Mark Troutman, hey, yeah. So Mark and I met in person this past weekend in lovely Fort Worth, Texas, as part of the Rock Retirement Club's rodeo roundup, which was cool. Weekend-long educational fest and community building event for members of the Rock Retirement Club. Really good time. Great to see you, Mark. Hopefully you had a nice trip back to home. Mine, thankfully, was uneventful. All right. Yeah. Dave Fultz, man. You scared Cody. Come on. Don't be doing that. You got to be quicker on the trigger. All right. Before we get going, weight loss. I somehow lost a pound last week. That surprised me, considering I did not work out last week from having a wisdom tooth removed the week prior. I didn't want to overdo it. Being away last weekend, eating, drinking, but I'll take it. So anyway, 7 weeks in, as of this past Monday, I am now 167.5 pounds, down from 176.1. That's about 8.5 pound decrease over 7 weeks, which is good. It's in my target. Now coming up, as you probably saw on the schedule, there will not be a live next week. I will be away. There will also not be a live the following week. I will similarly be away. I'll be at a conference. I'll be working technically, but at a conference. But that Wednesday night, there's actually a big party. It's in Denver. There's going to be a party on the field of whatever stadium the Broncos play in. I don't know the name of it. So I will not be around next Wednesday night. So next 2 weeks, I won't be here, which also means I won't be giving weight updates. And since I'll be away the next 2 weeks, part vacation, part conference, where there'll be more eating and drinking. Who knows what my weight's going to look like in a few weeks, but I will report back to you all. Dad jokes before we get into it. Sad news. My obese parrot died today. But mind you, it's a huge weight off my shoulders. That thing was a porker, man. He's hurting me. I had the worst night last night. The ghost of Gloria Gaynor appeared in front of my bed. At first, I was afraid. Then I was petrified. And finally, the CEO of IKEA was just elected Prime Minister of Sweden. The first thing he'll do is to assemble his cabinet with one of those little Allen wrenches and 1,000 pieces of particle board. All right, that's the dad jokes. Hope you enjoyed. Final bit of housekeeping. Where is it? Is the disclaimer. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, investment advisor, which I am not. Tonight, I'm just playing the role of some random fellow here on Facebook talking about the voodoo behind the legislators trying to come up with tax changes. Wildly exciting stuff. Okay. Where are we at? Ooh, Mary liked the Gloria Gaynor one. Yeah, first I was afraid. I was petrified, thinking how I could live without you by my side. All right. Oh, man. Mark Loss, Mark Trotman, make an inside joke to me, allegedly dancing a bit at a live outdoor music venue called the Flying Saucer in Fort Worth. It was not dancing. There's a bit of a saunter I did as I took some tip money up to the band that was performing, but I assert that it was not dancing. Rest assured. Okay. Mr. Lau, man, Dave Faults ask for Mr. Lau. All right, finally, one more bit of fun here before we do it. Dave Faults likes this guy. So pretend I just told my last joke and pretend it's a real ripper. Normally, I would put this up. That's the Mr. Laugh that Dave Faults is referring to, for those of you who are not familiar. Okay, let's do it. Tax changes. Now, I'm not a political expert. In fact, I don't like politics at all, nor do I like the political or legislative process. In fact, growing up, the first C I ever got for a semester or for a year was in civics class in 7th grade. I attribute that to a horrible teacher who was old and cranky and clearly didn't want to be teaching anymore. He was just riding out his tenure, probably. I don't know. But anyway, that's the first class that really like hit me in the face. I was like, man, I do not like this subject, and it was civics. So that kind of set the tone for me politically. I do not like politics. I'm not registered to either party. For those of you who care, I have views that straddle both sides of the political spectrum, which is interesting because I have family members. Some are very far right, some are very far left, and the ones who are very far right call me a liberal because I'm in the middle, not right enough, and the ones who are very far left think I'm a conservative because I'm not fully in their camp. It's sad and funny how politics works. But so point is, I don't have to be dangerous when it comes to politics and political process. I try to keep comments and my opinions out of it. As you know, in this group, taxes, for better or worse, are largely the result of political motives and political actions and political power. Tax legislation can be used to affect social change or a social incentive, like giving out energy credits and things like that can help spur social agenda. It can be redistribution of wealth, obviously. Take more from those that are wealthy, give some of that to those that aren't. That's another political tool. So there's lots of political levers that are put in place by way of tax legislation. So there's always going to be some sort of political underpinning to taxes, and therefore taxes and retirement. And I understand and appreciate that, but it is possible, believe it or not, for rational, fair, level-headed adults to say things that are just fact. XYZ was proposed. That's a fact. You don't need to say the commentary behind it that so-and-so is a bonehead or whatever, or, so anyway, I try to keep my comments to myself. Occasionally they may come out, but the point is, tax legislation is often politically driven. Doesn't mean we need to love it or hate it, but we need to deal with it as retirement planners, as tax planners, as interested individuals who want to know how to best use tax code to help ourselves or avoid mistakes. You have to be aware of these things, regardless what the political motivations are belying them. Be aware of what they are. With that said, tonight's discussion, as I mentioned before, was intended to be a summary of the handful of wish list items that Biden originally proposed earlier in the year. The important thing to know is at the time, they were just proposals. They were talking points. They were wish lists. They weren't actually legislation. I think technically they were put in what's called the Green Book, informally called the Green Book, which is like a proposed fiscal year budget that was put out that has kind of a wanted agenda of how things will be financed. And in that had like a dozen different points, one of which, and these were the hot topics that you saw a lot of news about and a lot of speculation and ranting about earlier in the year. Things like the removal of step-up and basis. That was one of Biden's wish lists. Things like the increase in the capital gains tax rate to be the max ordinary income tax rate of 39.6% for high earners. That was on a wish list, and a handful of other things, and increasing corporate tax rates. Those were all just wishes, right? They weren't actual draft legislation. The way politics and these things work, to my knowledge, again, I'm not an expert in this, is that those are kind of floated out there in the public just to get people's temperature, not just the masses at large to see how well or poorly things are received, but also those within both political parties. If everyone unanimously bashes and hates on and spits fire all over a particular proposal, well, guess what? Chances are that's not getting anywhere because it's clear there's not enough support to even bother wasting time and energy trying to eventually get this into legislation. Other things, though, that aren't hated on so much or are otherwise fairly well received, at least within the party, if there seems to be enough, informal support, or at least lack of ire and hate, then these things will, they're on people's minds, that when legislators do draft legislation, these things may make it in it because they suspect there's a chance they may get somewhere. So there's always legislation that comes and goes. Some at the last minute, some is put out and kicked around for a while. Some gets proposed and just completely dies on the vine and gets nowhere. The most tangible possible legislation I saw was, like I mentioned about a month ago, there was what's called Responsibly Funding Our Priorities. It was put out by Senator Neal, and it had bipartisan drafting support from, I forget who the other one was. But that was at least a positive sign, because there's a Republican and a Democrat who both had their name on it. So in theory, that one could have went somewhere, and so may. Who knows? This was the one that I summarized in the group. I shared the PDF. I can bring it up for you all. And this is why I'm conflicted with what to do tonight. I don't know how many of those things will actually get anywhere, if at all. Add to it, just yesterday, or maybe it was Monday, there was a new proposal from Senator Wyden that kind of trumps and overrides some of the things that were in Responsibly Funding Our Priorities. Which ones will ultimately get anywhere? I don't know. So I frankly don't know where to focus my time tonight, because who knows if any of these things will see the light of day, and if so, when. But I'm here. You're here. I feel like I got to talk about something. So let me start by what was discussed most recently in Senator Wyden's proposal. I think it was yesterday, actually. You may have seen this. Just looking at comments here. Nice. Thanks. I'm actually getting a haircut tomorrow, because I'm going to be away for 2 weeks, and I didn't quite time this well. I got a haircut a week and a half ago in anticipation of being in Fort Worth last week. Now I'm going to be away for 2 weeks. I kind of feel like I can't really go 3.5 weeks without a haircut, so I'm going to get one tomorrow. My guy's going to be like, "What are you doing here? I just saw you a week and a half ago." I'm like, "Yeah." Anyway, thank you. So last night's or yesterday's proposal from Senator Wyden was a 107-page bill. The main takeaway is that it proposes to tax unrealized gains for billionaires. Specifically, the people that would be sucked into this are people whose net worth is over $1 billion, or they have $100 million of income. And these two things, one of these two things needs to happen 3 consecutive years in a row. So if your net worth is $1 billion today and your income is tiny, your net worth drops next year to 900 million, only 900 million, you don't get caught up in this. It's only if your net worth is over $1 billion or your income is over 100 million for 3 consecutive years in a row. That's what this applies to. I've read conflicting info, but apparently this is only 700 to 800 people in the country that will be impacted by this. It's the names you've all heard of, the Bezos, the Elon Musk, the other, multi billionaires. The proposal is that it's not right that these folks can have really low, if not zero, income tax, because most or all of their income, or most or all of their wealth, if you will, is in the form of unrealized gains. And as you all know, you sharp folks in this group, you're not taxed on unrealized gains. You're only taxed when you eventually sell something, you have a gain. Well, what a lot of these super wealthy do is, one of the strategies is, a lot of their wealth is in shares of Tesla or Amazon or whatever. They don't sell it to realize gains and to get cash. Instead, they can often get loans against it. When you have hundreds of billions of dollars of stock, even though it's risky and can drop by half, you can still easily borrow, lots of money against it. And loans are not taxable income. So loans are one way. Loans against their billions of dollars of wealth is one way in which the ultra wealthy can cash flow their lives, if you will. So the proposal is simply that if you meet this rolling 3-year test of having $1 billion net worth and or $100 million of annual income, your unrealized capital gains will be taxed in those years that you have it. Illiquid things like real estate and businesses, that's different. That'll still be allowed to get deferred, but liquid things, tradable things like stock, you will have to pay tax on it, on your unrealized gains that year. Now, the difficulty is, okay, great. stocks continue having phenomenal years. They pay a lot of capital gains on it. What happens when the stock market drops or reverts in the next year or two, and they no longer have those gains, yet they already pay tax on it? They got that thought through, sort of. What will happen is you can take subsequent years' losses and you can retroactively apply them to 3 years prior. You'd have to then do an amended return to get a refund for some of the capital gains tax you paid, in prior years, but shouldn't have because stocks have since dropped. I don't know if this is going to pass. Because if for no other reason, the reason I said that this is going to be real clunky. There will be gains that they pay tax on that they subsequently have to erase and amend returns and get refunds because those securities have since dropped. This just seems unnecessarily wieldy and clunky. Now, I get the tone and the environment in which the spirit of this proposal is written. There's lots of ire and angst against the ultra wealthy, multi-billionaires. I'm not saying I agree with it, but I at least understand where that thought's coming from. I just don't see how this can feasibly happen. Furthermore, apparently, according to the Wall Street Journal, there's even questions as to whether or not this is constitutionally allowed. TBD if that's the case or not. Maybe it's just a stalling tactic. I don't know. But that's the most recent proposal I'm aware of. Again, this came out yesterday or maybe Monday from Senator Ron Wyden, I think, of Oregon, who's a Democrat. Don't know. And okay, so that's one thing. Not going to affect any of us here. Well, maybe, who knows? Maybe there's some ultra billionaires in the group. I don't know. But again, this is intended to target like 700 to 800 people, apparently. Now, there may be other things in that bill. Frankly, I didn't look through it. Again, 107 pages. I just looked at sort of the headline summary from Wall Street Journal, and that's what it said. There could be other things as well. The other one that I thought was more realistic, more likely to actually happen, but even that's now up in the air, is the one from mid-September, the responsibly funding our priorities. And let me pull up a screen share of those things. We'll discuss them here for the fun of it. Again, I don't know if any of these are going to go forward at this point, but who knows? They're at least somewhat reasonably sounding. So it's quite possible. So let me get my screen share. Yep, here we go. Now, the reason why I said who knows if this is going to happen is the Congress is so tightly divided. Senate, for example, is 50-50. The House, I think, is only marginally in Democratic favor. And with midterm election coming up next year, 2022, who knows? Balance of power could change dramatically one way or the other. As of now, though, it's tough. Basically, any proposal put forth by Democrats needs like full support from the entirety of the Democratic Party within the two chambers of Congress to get stuff through. The issue with this responsibly funding our priorities, apparently, from what I've read, is that Senator, I think Sinema is her name, in Arizona, is the holdout. And she basically, her view is that she doesn't want to see just a wholesale increase in tax rates, either the highest individual income tax or corporate tax rates, even though that is pretty clean and elegant, if you will. She doesn't want it. So she's holding out. And all it takes is one holdout, again, because the political power is so tightly divided. All it takes is one holdout in the Democratic Party in the Senate to not get something through. So that's why I'm thinking that this may not go through, or a lot of this stuff may not go through. And my suspicion, and I think part of the reason why we saw the most recent proposal from Wyden about this billionaires wealth tax, is because of Sinema's objection to responsibly funding our priorities, and objection to just a wholesale increase to corporate tax gain rates and the highest individual income tax rate. But anyway, let's go through this. I think some of these will happen. Just my guess. Obvious ones are the increase in top marginal tax rate. And I should say this should jive. A lot of these things do jive with Biden's original proposal. Not that means they're more or less likely to pass, but they shouldn't be surprises. All the while, for the most part, the line Biden has been pulling is that he doesn't envision or doesn't intend to increase taxes for people making less than about $400,000. Now, he didn't exactly define what does it mean to make or have $400,000 of income, but that was sort of the informal hurdle. And this responsibly funding our priorities jives with that, more or less. So that's why I thought this has a decent chance of getting somewhere, but who knows. So the proposal here would be increase the top marginal tax rate, individual tax rate, from currently 37 to 39.6. and specifically make that apply to people, single folks who have more than $400,000, or married filing joint who have more than $450,000. This would apply next year, 2022, if passed. Not tremendously shocking. The only kind of big news here is this does undo some of the Tax Cuts and Jobs Act, in which case, this higher 39.6 income tax rate was already set to go back into place in 2026, albeit at a higher level of income. This proposal is dropping that level of income down to $400,000 and $450,000. I suspect this may go through, but again, I don't know. All it takes is one Democratic holdout, and this thing's dead in the water. The other one, or one of the other ones, is the increase in the top long-term capital gain rate. As of now, the highest capital gain rate federally is 20%, plus the 3.8% net investment income tax, but the capital gain rate itself is 20%. Biden's original proposal was increased to 39.6, which fairly egregious, depending who you ask. I don't think that's going to happen. The proposal here was increased to 25. So not horrendous. I mean, not ideal, but still much better than 39.6. So that, and again, that would only apply to people who were quote unquote high income, which is that 450,000-ish level. Again, TBD if any of this actually makes it anywhere, but I think these are the most sort of substantive potential changes that may actually end up seeing the finish line, but who knows. This one, an additional 3% tax on ultra high income individuals, where ultra high income was defined as those with over $5 million of income. If you're married, filing joint, or single, there'd be a flat 3 percentage point tax on top of whatever your other taxes are. There'd be a flat 3% tax on any income over that level. TBD if that happens. Retirement plans. This is probably more of interest to you all. And we discussed this in depth throughout conversations and chats in the group. But again, I sort of feel like I need to have some sort of something to discuss with you all, because tax legislation has since changed in squirrely ways that I wasn't anticipating. So kind of messed up what I planned on talking about tonight. Let me pause there and take questions, I guess. I don't really know the best way to do tonight, but let me see here. What do we got? Sorry, just going through comments. Yeah, here's something else I said. So not repealing the SALT, which stands for state and local tax cap, would be ridiculous, since many states have instituted workarounds for the rich anyway. So SALT simply means prior to 2018, you were allowed to itemize deductions for state and local taxes, which are state income tax, property tax. Those are two big ones. So a lot of people, especially in high tax states, people with high incomes, like the West Coast, New York, California, New Jersey, Connecticut, etc., would have tens of thousands of dollars of deductions in state and local tax. New Jersey alone, I live in a modest house. Its property taxes are $10,000 a year. That right there fills me up. Add to that state income tax, and I'm well over this $10,000 cap. So I did read somewhere, I don't know where, I don't know if this was part of the Wyden proposal, but I could have swore someone proposed repealing the SALT cap for 2 years. I don't know what that would do, and then put it back in place. Maybe that'll happen. Maybe it won't. I don't know. Yeah, okay. For the billionaire proposal with the IRS, ask everyone for their net worth and to prove it. Yeah, I don't know. This is one of those devils in the details. I don't think they've thought that through, or maybe, who knows, maybe it was in the Wyden proposal and I just simply didn't read it, to be honest. All 107 pages, it may have laid something out there. Yeah, that's a good question. I don't know. Obviously, they have your tax return, but tax return doesn't show asset size. I really don't know how they do this. Looking at the Forbes list is probably easy, but still, there's surprisingly a lot of people out there who have over $1 billion you never would have thought of. Average-looking folks who just own businesses or work in lucrative, lucrative careers and just made stupid amounts of money over their life. So I don't know. With the step up in basis, they never pay tax on those huge untaxed gains when they die too. Yes. So one of Biden's original proposals was removing step up in basis, or at least capping it. I think it would be like $1 million lifetime exemption, such that the ultra wealthy, or anyone who died with more than $1 million of stuff, only $1 million would get stepped up in basis in the hands of the heirs. The remainder would all be treated as a taxable sale upon death and transfer of those assets. Now, that had its own problems. If it's liquid things like stocks and bonds, fine enough. You can sell them and liquidate it. But like family farms and private businesses, you transfer a $10 million business, you can't sell that and free up cash. So that was going to have some exception and carve out. As it stands now, but yet whoever made this comment, I guess where you're pointing this is folks who are billionaires. If they have billions of dollars of stock and that stock has billions of dollars of unrealized gains, yes, under current tax regulations, if and when those people die, all those assets get stepped up to whoever they leave it to. Now, they will have massive estate taxes on it, so the government's at least getting some cut of it. But in the hands of the heirs, at least, all those things are stepped up and the unrealized gains do go away. Again, partially offset by large estate taxes. Oh, yeah. Warren Buffett said that his secretary was in a higher tax bracket than himself. Exactly. Warren Buffett was one of, or still is one of the richest folks in the world. At one time, he may have been number one and then eventually passed by Buffett and by Gates and Bezos and now Elon Musk. But yes, I think that's, again, not saying I agree or disagree with this, but exactly. Warren Buffett, no qualms in admitting that his tax bracket was lower than his secretary, and he makes substantially more and is worth substantially more, I should say. Okay, what else? Who will be the first trillionaire? Elon Musk? I don't know. I think, what's it, about 300 billion now is his net worth? If Tesla ever gets to be worth that much, this world's got bigger problems and things are otherwise out of whack, but who knows? I guess it's possible. Here's another one. So another proposal, and I don't know if and when this has been in any legislation yet, but one of Biden's original proposals was to, and this was back earlier in the year, not just recently, was for banks and financial institutions to have to report to the IRS any transaction in excess of $600. The intention, or the stated intention, was that this would be a way to help catch transactions that people are otherwise doing as a way to circumvent taxes. And there is some merit to it. There are, I'm sure, if they did do this, they would catch a lot of ultimately taxable transactions and start raking in some more tax money. But first big problem is financial institutions aren't set up to do this. It would be a massive, massive undertaking and expense, and who knows if they can even get it done at all, let alone on time. To actually have the pipes and plumbing and capability to report to the IRS every single transaction over $600. Now, what I did read a week or two ago was that this is walked back. This was, there wasn't enough support for it. Now, the revised kind of proposal is a $10,000 limit. Any transaction at a bank over 10 grand would have to be reported to the IRS with some carve outs. So like payments, wages, if you make a lot and you get a paycheck for $15,000 direct deposit into your account, that is not something that has to be reported because they already know that separately gets reported on a W-2, et cetera. So it'd be like other random deposits into your account. Those would potentially get reported. Again, just a proposal. Don't know if it'll happen, but I agree with this. $600 transaction reporting requirement was bananas. I'm not fundamentally opposed to the idea of banks having to report some level of transaction. I don't know what that right number is. 10,000, who knows? Fundamentally kind of makes some sense, but at what level and what other provisions and exclusions and tweaks and nooks and crannies you have to this? I don't envy the people who have to come up with this idea. Andy, will you upload that to the files? I assume you are referring to this summary. I am this responsibly funding our priority summary. If you want to see it, you can get it from, hold on. I already have it. Here you go. I already have this saved on my website as a downloadable PDF. You do not have to put in any email or phone number or anything. It's free to get. teninfinancial.com/RFOP, which stands for responsibly funding our priorities. This is what you're looking at here. This is this PDF. Again, free to get it without having to give up any of your info. So for those of you who want it, there it is. It's also saved somewhere in the group, I think. I don't know, but just you can go here to get it. That's fine. All right, back to comments. Where are we? Any data on why 400,000? What percentage of people are in this category? Ooh, good question. I don't know. I assume it came from somewhere. I don't know why 400 is a magic number. I would like to think there was some analysis done to see what percentage of the population would be captured by this. I have no idea what that percentage is, but no, if anyone knows, please share it because that would be cool to see. Mark Troutman wonders if the 0% long-term capital gains tax bracket will ever be on the chopping block. Possibly. I mean, in theory, every single aspect of the tax code is potentially able to be on the chopping block at some point. I think this is such low-hanging fruit, though, that it not no wrong saying, not low-hanging fruit. Such a non-issue in the grand scheme of things. I don't think it matters. You know, this only applies for people with total taxable income under 40-ish grand if you're single, 80-ish grand if you're married. That's small peanuts in the grand scheme of things. And again, that in theory, that expressly is targeting folks that are well under the $400,000 bogey of what's determined to be a high income person. All right, Mario, good reminder to have me stop rambling and ranting and get back on track here. So let's now talk about, you can still see my screen share, changes to retirement accounts and plans. Again, this is all just proposal. I thought it was a pretty tangible proposal that had some good legs to it that may actually get somewhere. At this point, damned if I know. I wouldn't be surprised if it's like last week or two in December, this thing comes out of nowhere, resurfaces, gets jammed through in some iteration, kind of like the Secure Act, late 2019. I don't say it came out of nowhere, but it wasn't heavily on people's radar for a while. Then all of a sudden, it was like last week in December, this thing got passed and went into effect, a week later. I wouldn't be surprised if this is what happens here. So Mario's question, proposed changes to backdoor Roth and Roth conversions. So right here, let me just take this off screen here, Mario. There's a couple things that only apply to people with IRAs over 10 million bucks or retirement accounts over 10 million bucks. I won't get into those here. Take a look at that summary for those of you who are interested. This is the more important one. This is the bigger one. As proposed, and again, who knows if this is going to happen, but as proposed, high income people, where high income again means 400,000 total income if you're single, 450 if you are married filing joint, and this is taxable income technically. And these are also going to be indexed for inflation. So over time, 400 and 450 will become 405 and 460 and whatever. Starting in 2032, so not next year, but 2032, anyone who's high income at the time will no longer be able to make any Roth conversions, period. Whether it's in their 401k, their 403b, or their IRAs, high income people would not be able to make any Roth conversions starting in 2032. That's one thing. The other one, quasi-related, is this point here. Backdoor contributions to Roth would no longer be allowed. What exactly does this mean? Well, backdoor isn't a technical tax legislative term. It just simply is the term used to describe making a non-deductible, aka after-tax contribution to a traditional retirement account like an IRA or traditional 401k, and subsequently converting that after-tax money into a Roth account. Upon conversion, that the after-tax money that's converted is not taxed because you already paid tax when you first contributed it. So that's a backdoor contribution. As proposed in this responsibly funding our priorities legislation put forth in mid-September, starting in 2022, no one, regardless of income, no one would be able to convert any after-tax monies from traditional IRAs or 401ks into their Roth counterparts. So this doesn't mean that if you have an IRA that has some after-tax money in it, it doesn't mean you can't do any conversions. It just simply means you can't convert that after-tax portion of money. You can still, in theory, in my reading of this, still convert the pre-tax money over to a Roth IRA, but you can't convert the after-tax contribution money that's in there. Now, how mechanically this would actually work, what form would be used in a tax return, don't know. This is sort of the beauty of tax legislation. Legislation is thought up and concocted and put into law by politicians, but then it's up to the IRS to interpret and implement said legislation. So the IRS may not be aware of what the legislators are thinking. Legislators may not know what the IRS can and can't do, or at least how difficult these changes may be to interpret and put in place by the IRS. So, point is, if and when this is approved, such that you can't convert after-tax money starting next year, I frankly don't know what exactly the process and tax forms will look like and what the mechanics will be to do a conversion out of an IRA, for example, where there's some after-tax money. There's going to have to be some, not pro rata, but I just don't know. Like it's going to be interesting if this passes. I foresee this passing. Think about it this way: for no other reason, the fact that this is called backdoor, kind of by definition, you should think this is going to go away at some point, right? Now, again, backdoor is an official tax term, but the fact that this is widely called backdoor implies this was something that wasn't intended in the first place. So don't be shocked, don't be surprised, don't cry if and when this goes away. I assume it will. Whether or not it's 2022 or some point later, I don't know, but I fully expect this backdoor Roth contribution thing will be going away at some point. Did that answer your question, Mario? Okay, where are we? Sorry. Look at the comments here. A lot of comments. Good. All right. An unwarranted political comment here that I will not do the justice of putting on screen. Adds no value to the discussion tonight. What's Dave Myers have to say? The 2001 tax cuts, which eventually temporarily eliminated the estate tax, effectively replaced it with capital gains tax because it eliminated step up above a fairly low threshold. Okay, thanks. Aren't they doing the 10,000 already for money laundering? Sort of. So different things. The proposal put forth is that any transaction above $10,000 or maybe $10,000 or greater would need to be reported to the IRS, and that would include any electronic deposit. Things would be carved out, like I said, like direct deposits from payroll or whatever, or legal settlements. I don't know, things where there's already a tax record of. But other things, like if someone Venmos you, $11,000, or you transfer from Venmo $11,000 into your checking account, that would have to get reported to the IRS under the proposal. What you're referring to, whoever posted this, the $10,000 hurdle is a anti-money laundering thing, but it's not a mandatory report to the IRS thing. I'm not a banking expert, but I think it's just if you deposit cash, if you walk into a bank and put in more than 10 grand in cash, they do have to ask some questions and file something. I don't know that ultimately goes to the IRS. Maybe it's just some additional diligence where if they suspect it's fishy, then sure, then they may further report it to the authorities or to the IRS. I don't know. But nonetheless, $10,000 of cash deposits is a trigger within banks where they will ask you more questions to figure out, hey, what are you doing here? So that's a little different. That's just cash. If you get a check for 12 grand from whoever and you deposit that to your bank, that does not trigger off any special questions or extra diligence from the bank because there's electronic record. It's cash where I think they want to know, hey, where'd you get this? So similar to what Kenan's saying, the 10,000 year transaction thing is based on legislation implemented by India a few years back to try to get black money out of circulation, which was interesting. I worked with a handful of folks from India at the time who were here in the U.S. And they and their families are really concerned about this because apparently in India and I think a lot of countries, there's a big black market / cash market / off the taxing authorities' radar market where lots of things are transacted in cash and not reported. I believe it's common practice. So I think it actually went into place where if anyone, I forget what it was, but it's really punitive. Like banks would no longer be able to accept cash bills in denominations that were roughly $100 or greater, something like that, which was big. $100 isn't a lot. And this was specifically to get people to take money out of the black market / untaxed market, kind of force them to get their cash into the financial system, so it would at least be recorded and therefore taxed at some point, which fundamentally it isn't an egregious ask to try to do. But I understand after generations of black market / cash market culture, that rubbed a lot of people the wrong way. Okay, what else we got here? Sorry, I see people already commented, like Mark was saying, that was just for cash transactions. So thank you. Who's this? Do you think the proposal to tax unrealized gains will affect those billionaires? Do you think that this opens the door for taxes to increase for the working class if it doesn't actually end up taxing the rich? So many rumors against this proposal saying that it's just a way for the government to come ask for some point. Depends who you ask. For what it's worth, I equally despise the far left and the far right, but this sounds like some rhetoric steamed up from the far right, and who knows? You don't know what the politicians are thinking. Maybe there is some underlying motive for, let's get this in place first for the billionaires, and then we'll just keep ratcheting down the threshold of who this applies to. That's very possible. I'm not saying it's not, but at this point, just my opinion, but I don't think this is like a land grab to start with these 800 billionaires and then just continually rake in more and more people to have this apply to. But that's me. Who knows? Maybe I'm too fair and honest and whatever to think this is possible, or too gullible. I don't know. Interesting. Here's an interesting one. So I'm just looking at what is the benefit to stopping Roth conversions? Doesn't it reduce current tax revenue now? That's exactly right. It would, which is why this seems a little silly in many respects. So all else equal, the government should like Roth conversions, because Roth conversions bring in taxes in the year they're done, and getting tax revenue is always good. I suspect a lot of these proposed changes to Roth conversions and backdoor Roths, and this limit that's mentioned in the summary about people who have retirement accounts in excess of $10 million have to start taking RMDs from them regardless of your age. I suspect a lot of this is, I don't want to say to placate, but to even appease sounds bad. I don't want to use these judgmental sounding words. But in response to some recent news and articles that there are some really wealthy people that have, I won't name names, but there's a guy who had some early founder shares in PayPal for like pennies, who bought them in a Roth IRA. That Roth IRA is allegedly now worth like $5 billion. $5 billion. That doesn't sit well with people on a certain side of the political spectrum, that an ultra wealthy person is able to use a Roth IRA to get tax-free growth and ultimately tax-free distributions on $5 billion worth of assets. I kind of get it. I see why people would be upset, but this guy did nothing wrong. Roth IRAs, he used it as it's supposed to be used. Buy something in there, hope that something goes up a lot. All that gain is eventually tax-free. That's what he did. Separate question now, unrelated to his usage of the Roth IRA, was whether or not he was able to buy these things in the first place in a qualified account, because he may have been, an insider, but separate story. But good for him. He used IRAs to his advantage, and he bought something exceptionally cheap that became exceptionally expensive, and it's all tax-free. Nonetheless, that rubs people the wrong way, and I think that is the tone behind which a lot of these restrictions on Roth conversions and having large Roth accounts is, this is where it's coming from. Not saying it's right, but that's my suspicion. But otherwise, yes, this does sort of fly in the face of the government's incentives, because you would think they'd like Roth conversions because it means more tax for them. Okay. Any limit to only publicly traded securities and IRAs? Not sure what this is in reference to, but no, as of now, and I think even going forward, I don't think there's anything. And I know where we're going with this. Sorry, hold on. Do I have it in here? Yeah. Okay. So this is probably what you're asking, whoever this is. Another one of the proposals in the responsibly funding our priorities thing was that IRAs and I think by extension Roth IRAs, because in tax code Roth IRAs are kind of like bolted on to IRAs in terms of a lot of the rules and provisions. If passed, the proposal is that any investment that requires the investor to be quote unquote accredited, which means that that investor has to meet certain conditions either around wealth or income or financial industry experience or knowledge or education, things like that. Such investments would no longer be allowed to be purchased or held inside an IRA. So if you already hold something that's a private investment, for example, like a hedge fund, you would have to get rid of it within 2 years if this proposal were to actually pass. So to whoever asked this, I guess this is where you're going. Yes, that would in effect mean, if this passes, that would ultimately mean that basically only publicly traded, liquid, unrestricted securities that do not require any special investor accreditation would be allowed inside IRAs. Now, I don't know that this will pass, or if it does, there's going to need to be a lot of heavy changing of language, because some investments, as it's written, people who have such investments now would need to liquidate them within 2 years. I know firsthand from having worked in alternative investments for a while, it's just not practical to be able to liquidate some of these things in 2 years. You physically can't. So they're going to have to change this, or grandfather, maybe, people who already own stuff can continue to hold it, but going forward, you can't buy anything new. That I can potentially see happening. And I also think this may be the result of that article I was referencing, where one of the founders of PayPal bought shares for pennies when they were private and they weren't publicly available to other folks. So that person had to be accredited. Now they're worth $5 billion. This also smells like this was proposed in response to some outcry about that article. All right, what do we got here? One other thing that I thought was mentionable in the responsibly funding our priorities was the reduction in the unified credit. Let's explain this neatly. So you've all probably heard there's an estate tax exemption. If you die with up to X amount of dollars worth of estate, you don't have to pay any estate tax federally. Some states have estate tax, and those thresholds are much lower. But currently, as of 2021, the federal estate tax exemption is $11.7 million per person. That means if you die with less than $11.7 million worth of stuff in your estate, there's no federal estate tax. But this is called a unified credit because it doesn't apply only to assets you pass upon your death. It jointly applies to assets you give away during your life. So if you gift to your child $5 million this year, for example, you will have used up $5 million out of the $11.7 million of unified credit. That means that when you die, you now only have $6.7 million of estate tax exemption. You dig? You follow? That's what that means. This was already scheduled to get halved in 2026 as part of the sunsetting the Tax Cuts and Jobs Act. The responsibly funding our priorities draft legislation put forth last month, would speed up that halving to 2022, actually. So starting 2022, it would revert to like roughly $6 million. Shouldn't be surprised. Writing's on the wall. This was going down anyway. This would just sort of accelerate it a little bit. Who knows if this passes again? And I wouldn't be surprised if the estate tax limit / unified credit goes down even further at some point. So in the not too distant future, early 2000s, the estate tax exemption is only like $1 million, I think, a couple $1 million, and it slowly ticked up from there. So it's not out of the question to think the estate tax exemption could drop back down to only a few $1 million, or maybe even less. I don't know. But don't be surprised if this thing further drops below the $6-ish million that it's expected to be in 2026, if not sooner. All right, and related comment from Mark Troutman. Yeah, good for catching this. So with married couples, the way these unified credits work, so again, for 2021, it's $11.7 million per person. For a married couple, each spouse gets $11.7 million. When one spouse passes, the surviving spouse can take the unused credit, potentially all $11.7 million, and tack it onto his or her own, such that you now have, let me see if I can do the math quickly enough, $23.4 million of unused unified credit for the surviving spouse. Now, my understanding is if and when these things are reduced, whether it's as a result of the Tax Cuts and Jobs Act bringing it down as scheduled, or new interim legislation, newer legislation, bringing it back prematurely, if and when a spouse dies and you port over that spouse's unused credit, I don't think that unused credit will get halved going forward. So in this example, spouse dies this year in 2021. The surviving spouse takes over the deceased spouse's unused 11.7 million credit, adds that to his or her own. That surviving spouse now has $23.4 million unused credit. If and when let me take this back. If you actually fill this up, so if you actually gift $23.4 million now, and this limit subsequently drops, they won't claw it back from you. What I don't know, Mark, and I think we discussed this weekend, and apologies if I forgot what we came to. I don't know if the unused portion you poured over from a spouse will get reduced. I don't think it will. I think your portion will if and when it reverts back, but I don't know if the ported over unused spouse portion will get halved, or if you get the benefit of getting to keep that at whatever it was when the spouse passed. I don't know. If I did know, I forgot. I don't know. Okay. Looks like, all right, we'll stop it there. I mean, I'll hang out, take any questions anyone has. All right, yeah, I'm just looking at some comments here. Things going off the rails a little bit, but any comments, questions? Doesn't need to be related to this tax stuff. Again, this is all speculation. None of this is law yet. Don't worry too much about what I'm saying. Just know these are things that have been put forth in draft legislation. So in theory, they have a better chance of seeing the light of day as opposed to just talking points that were expressed earlier in the year. But still, who knows if and when any of this stuff comes to fruition and makes it into law. Mariel missed where my RFOP summary is. Hold on. You can find it here, Mariel. Did I spell this right? Yeah, teninfinancial.com/RFOP. This will pull up the PDF that you can freely print or download and save at your leisure. Feel free to share it, whatever. Don't bother me none. Hopefully people find this helpful. There was another question here I see. Any limits on 1031s in it? Yeah, but I didn't summarize those. So 1031 is referring to a 1031 exchange. That's when you own a rental property, basically, or other business properties. But a rental property, you want to sell it, or you want to get out of it, I should say, and you have a taxable gain. Instead of being forced to realize the taxable gain when you sell it, you can, in essence, roll it over into the purchase. You can roll over the sale proceeds into the purchase of another comparable type rental property. Now, that doesn't get rid of the tax. That doesn't get rid of the gain. It just simply kicks it down the road and defers it. So when you eventually sell whatever ultimate property, then you have to realize it. As of now, I think, don't quote me, but I think if you die, all this kind of unrealized, kicked down the road gain from these 1031 exchanges, I think that might all go away due to step up in basis when you pass this on to your heirs. I think, not sure. Okay, so yeah, I don't know. Whoever asked this, I'm sorry, I did not bother to look too much into this. I didn't. I don't have a good reason why. There was some sort of mention of 1031s in it. I don't know if it was in the responsibly funding our priorities or the most recent one from Senator Wyden, but that will be something to Google, I suppose, and look. I don't know. All right, that is all I got. Unless anyone has anything else, let me stop my screen share here. Stopped. Again, sorry to let you all down, but there will not be. Let me get rid of this banner. Why is this here? There will not be any taxes and retirements for the next 2 weeks. I will not be here. So apologies for those of you who eagerly look forward to this every Wednesday evening. Is there a limit on the step up at death? Currently, no. As proposed in legislation, draft legislation I've seen, no. This thankfully has not actually gotten any progress in making it towards law as of now. Thankfully. I'm glad it's not. It would be real unwieldy to try to do that and put this in place. For example, if you inherited stock from someone that bought it 40 years ago, who knows what the basis is? There's no way you're going to be able to know what the basis is if you inherit it and have to pay tax on it. So practically speaking, I don't think removing or eliminating step up in basis is simply feasible to do. But my guess is that's why, one of the reasons why this has kind of gotten squashed and hasn't really made it anywhere. Okay, that's it. Well, thank you all. I will stop there. Have a good few weeks. I will see you again on whatever date it is 3 weeks from now. Take care.